Hey guys, welcome back to another video. In this video, I'll be talking about what happened in the recent events of the S&P 500, which is the stock market basically, and why there are many fear, speculations, and crucial things that we have to talk about to make sure that we all stay informed and I get to say what I've learned in the past few days. So basically, there has been a up and a down in just 2 days for the S&P 500, and I'm going to talk about it and why. And now to my first point, which is the Federal Reserve's recent actions and the market's reaction. So on July 31st, the S&P 500 had a great increase in price. So basically they went up 1.58% in one day, and that's a lot for one day. At some point of the day, they even went up to 2.1%, which is crazy. But the next day, they took a nosedive, which made them go down by 1.37%. But why is that? Why is that happening? That happened because, well, at first people was very happy about how there was hints of rate cuts in September, and then there is a high chance of actually cutting because the Fed seems to be pretty comfortable with the amount of data they will have and speculate to have by that time. And so most people think they're just gonna cut. They're gonna be a cut, so they're happy about it. But the second day, they started to have doubts on whether this cut would be too late, because since there are some signs coming up, they're afraid it's too late and recession will strike before these rate cuts can take into effect and, well, make things better. And on to my second point, which is the initial reaction of a rate cut and a long-term effect. So basically, what I'm saying is that it is important to understand that when an interest rate is cut, normally they have a negative effect, which means that the stock market will go down and people will not invest. But this is normally a short-term effect. And after a while, when the effects of a low interest rate kicks in, then positive effect comes in. Because basically, what rate cuts do is that when they cut rates, it makes it easier for businesses and people to get a loan and borrow and advance their businesses or their personal spending. So this is what the effects of rate cuts, and also the Fed wants to do quantitative easing, which essentially just means printing more money. And printing more money will increase the money in the economy, but yet it doesn't increase the goods and services, because you're basically increasing more handheld value on the short term, which when it's just printed, the value is the same, but in the long term, the value will fade. But this will also contribute to overall inflation, which could stimulate the economy for a while if the economy is bad. But why would the stock market be bad when the rate cuts is just cut? Is because some people initially would think that, oh, they're cutting the interest rates because the economy is not doing well and they have to save it. And because of that, most people will be afraid when they first cut it, but then soon the effects will kick in when people are starting to be able to borrow money easier and have more money to spend. And now to my third point, which is the mechanics of lower interest rates and quantitative easing. So I'm going to tell you how this actually works by giving you examples. So just for example, if the interest rates went from 7% to 3%, okay? I mean the interest rates for buying a house, like the mortgage rate, then clearly more people will start buying houses, right? Because now that the interest rate is lower, they would have an easier time paying off their loans in the distant future. So basically, this would also cause people to increase the prices of houses, because the amount of houses doesn't change. So there's more demand, mean higher price. I mean, they can offer higher price. And so quantitative easing is basically the same logic. They create more money by printing it, giving it to the people. Does that mean that everyone can buy a house? No, because the amount of houses don't change. only the amount of money in their hands change. Because if, let's just say, you are given 100 million and the house still remains as one house and everyone's just asking for that house to buy, do you think you'll be able to buy it for 100 million? No. The house is probably now 2 billion, because it works like that. It doesn't, because the amount of houses don't change, then that means that there are just higher demand with lesser supply. So this will stimulate economic growth because, well, there's more demand now, even though there's lesser supply. But at the same time, this will also spike inflation really hard. So basically, this is the mechanism of lowering rates and quantitative easing, which is what the government is trying to do. And now my fourth point, which is the upcoming Federal Reserve meetings and market expectations. So basically, looking forward, there should be about 3 more meetings in 2024, September, November, and December. So in September, there's a 100% chance that there will be an interest rate cut. And this is based on the Fed. And other than that, there's also a high chance of 96% chance of a November cut. But in June, they projected and said that there could only be 1 cut this year. And by March, they said that there could be 3 cuts this year. So that one needs further explanation in the data that will be given in September. By the way, there's a 78% chance of a 0.25% cut in interest rates and also a 22% chance of a 0.5% cut in interest rates in September, which I think 0.25 might be a little bit much or moving fast, but we'll see about that based on the Fed's decision and the data, of course. Well, according to the data, they look very much into the labor market, which is the employment, and the stable prices for consumption and demand, basically. So if the labor market, if the economy is, well, slowing down and inflation is under control, then they will probably most likely just cut rates in November as well. This is to stimulate the economy, just making sure the economy don't go into a recession. But if it is not, and it's the opposite, which the economy is overheating, inflation is just spiraling, then they will definitely not cut rates. In fact, they'll pause or they'll even increase interest rates to keep it under control. So depending on the situation and the data that will come out during September, we'll be able to find out which one is it, and we'll be more ready by that time. And financially, basically, we have to navigate it properly. And that's my fifth point, which is the economic indicators and their implications. So basically, despite the high GDP growth of 2.8%, it is good to note that the unemployment rate has increased to 4.3%, which is a very high number. It has been probably the highest in like 3 years. And the amount of employment that was increased went from 206,000 jobs in June to 114,000 jobs last month's report. And that's really bad, because the labor market is a strong indicator for the economy. If the labor market is strong, it means that the economy is strong. If the labor market is weak, then it means that the economy is going to be weak. It's one of the biggest factors that the Fed will focus on. If it goes up and down, they will bail them out whenever they actually need to, even if they don't grow according to their plan. And that's how important the labor market is. So basically, it's a very important factor. Not just that, the 10-year yield has also dropped to 4%, which means that people are having growing uncertainties, as in whether the economy is going to be good or not in the next few months. Basically, they think it's going to be unstable, so they'll seek like more stable investments. For example, maybe gold, you know, something that has a almost fixed value at this point of time. So basically, yeah, so basically many people are having doubts and labor market doesn't seem to be doing good. So many people are afraid that there could be a recession coming up before the effects of the rate cut kicks in, since they're doing it in September, which means it's not even cut yet. So in conclusion, the recent stock market drop is due to the cause of fear that many people think the recession is coming up, and the weakening the weakening labor market. So basically, there's going to be an upcoming rate cut, and even though we are going to be able to navigate the first starting effects, which is going to be bad, like I said, they seem to be having a pattern where they always have a drop in the stock market every time there is a rate cut. But after that, there should be a good performing results for assets. So basically, that's gonna happen. People are having fear of recession, but when the rate cut effects kick in, there should be a small period of time where they'll do bad and then they'll do good based on past records, which is basically what I've learned. And which is definitely not guaranteed. I'm just saying this is what I've learned throughout the process of research. And basically, keeping informed is very ideal for this time because, well, anything could happen. Maybe we'll fall into recession before the rate cut effects will kick in, but it is important to understand the factors at play. Anyways, this is the end of the video. I hope you guys like and subscribe. I hope you guys enjoy this video. I hope to see you guys in the next one. Bye.